Hello again. We are going to learn about interest rates. What do they present? Who is deciding on the base rate or the main rate in the economy? And what do these interest rates mean for you and your saving, and also for you and your potential debt? So interest rates represent cost of borrowing money. Or if you are saving and you have money, let's say in a bank, this is your return on your savings and your investments. They play a key role in the economy, affecting everything from consumer spending to inflation and overall economic growth. We're also going to teach at one of the following lectures close relationship between interest rates and inflation. So interest rate is percentage charged on your total amount that you borrowed or the amount earned on your savings or investments. It can be expressed as annual percentage rate or so-called APR or an effective annual rate or EAR. Components of interest rate. Nominal interest rate. It's interest rate that includes inflation. We did discuss that if you have money sitting in a bank for a long time, inflation is the biggest destructive power of your savings because it really erodes the value of your money and also purchasing power diminishing if there is inflation, high inflation in the society, meaning in a year you can buy less goods or services than now. So you always consider inflation rate in the economy and what it does for your saving and investment. So nominal interest rate includes inflation, while real interest rate subtracts inflation. So to get your real interest rate, you can check official figure for CPI, Consumer Price Index, which usually measures inflation, and you will subtract inflation rate from your nominal interest rate, and then you will know what your real rate of interest is. There are all kinds of interest rates. There are fixed interest rates, variable or floating interest rates, the ones that are based on simple interest, and finally, we have compound interest. The power of compounding is one of those wonderful savings inventions that can multiply and enhance the amount that you invested over the horizon. But the same works for debt. That your debt is actually escalating quite rapidly if they calculate compound interest on it. So fixed interest rate, it's constant throughout the life of a loan or investment, providing predictability for borrowers and savers. Variable or floating interest rates, these are changes over time based on market conditions or specific benchmarks. For example, in the UK, it used to be LIBOR, now it's called SONIA, a central bank rate. And they carry more risk for borrowers because payments can actually increase. And these rates follow the Bank of England rate. So over the last 2 years, Bank of England has been increasing interest rates, meaning variable interest rate was tracking the base rate. Similarly, when the base rate is decreasing based on decision of Bank of England Monetary Policy Committee, also variable rate is going to decline. Simple interest. This is calculated on the principal amount. Principal amount is simple. It is just original amount of money that you are investing. And this is calculated throughout the term of the loan or investment. It is calculated like simple interest equals principal times rate times time. Compound interest rate is calculated on the principal amount or original investment amount and also on the accumulated interest from previous periods, leading to potentially higher returns over time. This can be calculated by using this specific formula, where we actually are calculating future value of investments, which is A, including interest, which equals principal investment amount, which is initial deposit or a loan amount, and in a bracket we have 1 plus 1 divided by R, and R is annual interest rate, and then it is to the power of number of times that interest is compounded per year. Impact of interest rates on borrowing, Higher interest rates are cost of borrowing that are increasing, and this makes loans for homes, cars, education more expensive. This can lead to reduced consumer spending and borrowing. Lower interest rates also represent decreased borrowing costs, and they encourage individuals and businesses to take out loans and invest in growth. So what is the impact of interest rates? Let's first consider the savings. Higher interest rates are quite good because if you have your money with the bank, they will pay you higher interest. So your savings account will be doing better. And also fixed income investments encouraging saving. What about lower interest rates? They may discourage saving since the return on savings are lower, making it less attractive compared to other investment options. Impact of interest rates on inflation. Interest rates are driven and decided by the central banks, and they're looking at interest rates to manage inflation. Higher interest rates can help cool off overheating economy. What is overheating? Economy is doing well, many people are getting jobs, consumer spending is high, shops are full of people, so are restaurants, and this can actually lead to inflationary pressures. And higher interest rates can fine-tune inflation, bringing it down. Similarly, lower interest rates can promote economic growth and also can result in higher inflation. How do interest rates impact your investment? The level of interest rates can impact not just cash and your deposit rate, but also stock and fixed income or bond markets. When interest rates increase, bond prices fall, and existing bonds with lower interest rates become less attractive. Similarly, increase in interest rates has an impact on bonds with longer maturity. 10-year bond is also potentially government bond. It is the benchmark bond that major governments have. So if inflation is increasing, investors think that long end of the curve, which is government bond, can actually erode in value because long-term inflation will eat away the value of your bond. However, if inflation is falling and interest rates finally started decreasing, those bonds can have some better potential. Stock prices or equities can also be affected due to the borrowing costs for the companies. So how interest rates impact businesses? Small businesses can be adversely affected because many small businesses have debt. They take loans from the bank, from other entities, and they need to pay the interest which is higher on those loans. So all those companies that thrive on debt and loans, they are being adversely affected when interest rates increase because the cost of servicing the debt are going to increase too. So what about responding to these changes in interest rates? You can see now that you can read everywhere in the news that the Bank of England is considering to decrease interest rates. In the United States, Federal Reserve already decreased interest rates recently, and so did European Central Bank. So for borrowers, if you have fixed rates, if you anticipate rising interest rates, consider locking fixed rate for your loans, mortgages, because you believe the rates are going to be higher in the future. However, variable rates, if you think rates are going to increase in the future, your variable rate is also going to increase. If you have a mortgage, this means your mortgage costs will be higher. So evaluate risks of variable rate loans and then consider refinancing to a fixed rate if you think that rates are going to rise quite significantly. What about savers? Monitor interest rates and changes and consider high-yield saving accounts. Sometimes banks offer different deposit accounts where you cannot withdraw the capital within a certain time frame and they pay higher interest, or so-called certificates of deposit. They can offer better returns when interest rates are increasing. Also explore investment options that can perform better in various interest rates environments, such as stocks or equities when interest rates are low. Stay informed, follow economic indicators, central bank policies, market conditions to make informed financial decisions regarding borrowing, saving, and investing. So interest rates impact the entire society, and they are a fundamental aspect of personal finance, influencing borrowing costs, saving returns, and overall economic activity. Once you understand how interest rates work and their implications, you can make informed decisions to enhance your financial health. And of course, discuss and raise questions. Thank you for your attention.